Welcome to this quick explainer on the big developments shaking up the U.S. housing sector. Over the past few years, especially the last 4, we've seen major transformations in how homes are bought, sold, and financed. Let's break it down, starting with some key moves from the current administration. The government has been pushing forward with reforms aimed at making housing more accessible for everyday people. Recently, there was an announcement restricting large companies from snapping up single-family homes. The idea? Homes are for families to live in, not for big firms to treat as investment assets. On top of that, government-supported entities are stepping in to purchase up to $200 billion in mortgage-related securities. This is designed to stabilize the market and ease pressures on buyers. To get a deeper look, imagine we're chatting with a financial expert, like a president and chief investment officer from a global advisory firm. They would explain that this securities buyback helps by pushing mortgage rates lower. We've already seen rates dip a bit, with the 30-year fixed mortgage hovering just below 6%. That's a welcome relief, though it's not a game changer for everyone. Doing the math on a typical $400,000 loan, a drop of about 0.25% could save homeowners around $70 per month. It's not huge, but every bit counts when it comes to affordability. Experts are also calling for looser regulations to spur more building and lending, which could have a bigger long-term impact. Now, about that ban on corporate purchases of single-family homes. Nationwide, big investors own roughly 300,000 such properties. That's about 2% of all single-family rentals. These firms buy them up to rent out, but if the policy forces them to stop or even sell off some holdings, it might not flood the market overnight. However, in a sudden sell-off scenario, home prices could drop temporarily, creating opportunities for individual buyers. That said, the effects aren't uniform across the country. In certain areas, corporate ownership is much higher, and like up to 25% in parts of Memphis, Tennessee, or nearby regions in Mississippi and Arkansas. We're talking 21% around St. Louis, Missouri, and Illinois, 19% in Kansas City across Missouri and Kansas, 18% in San Antonio, Texas, and nearly 18% in Birmingham, Alabama. Southeast Florida is another hotspot where institutions have been aggressively acquiring blocks of homes. In these concentrated markets, limiting future corporate buys could reduce demand and soften prices, giving first-time buyers a better shot. Sellers might face more competition, but overall, it could balance things out. Keep in mind, these big players often target large developments or multi-unit complexes, not just the average neighborhood house. One under-the-radar boost? Enhanced tax breaks that flew under many people's notice. For seniors, there's now a $12,000 adoption credit if married. Wait, actually, let's clarify. It's more about expanded deductions for things like state and local taxes, now up to $40,000. Combined, these could mean thousands in annual savings, potentially freeing up cash for that next home purchases or upgrade. In summary, while these policies won't solve every housing challenge, they're steps toward making the market fairer for individuals over institutions. You are in the market. Keep an eye on local trends and consult a financial advisor. What do you think? Will this reshape your area? Drop your thoughts below.